Yo, what is up, everybody? We are back with another episode of Bullish Top Stocks to watch for the week and why, for the short week and why. Before we get into it, as always, hey, these are only my opinions. Do your own due diligence. I'm not a financial planner or advisor. These are just kind of my opinions, what I'm watching. Also, might be maybe what I'm playing as well. I try to show you what, but also why. In the end reason for this is to start a conversation, start a discourse, right? Let's talk about it. Let's have a conversation. You agree? You don't agree? I love either of those as long as we come from a place of a place of general respect, right? That's always a good thing. And also, hey, if you like this episode, go ahead and like it, subscribe to my channel. Really appreciate that. It's free, it costs you nothing, right? Also helps me feel good about myself. Also, real underscore bullish wherever you get your social media poisons. Some of these I've kind of already posted on different sites like StockTwits and Twitter and things like that. So that's kind of where I put more immediate things and make the shows like once every 2 weeks. Hopefully, like I said before in the previous episode, I just might. This is my second semester of MBA program coming up here, starting next week. Damn, next week already. So it's trying to find time to do this while I'm doing other like working, going to school and stuff like that, and my own general investments and shit on the side. So I really love doing this. I meet a lot of cool people. I have a lot of fun doing it, but I'm trying to like figure out how I can fit it into my life. I think it's going to be bi-weekly, which I hope means every 2 weeks, at the most a month. But I think I can do this every 2 weeks. I think that's what I can do. So I will jump into it if there's nothing else. I think there's anything else. Anyways, if you know me, I like looking at the SPY. I have it up on the screen right now. Basically looking at the week level here. The SPY is still down 13% from all-time highs. That all-time highs was late 2021, early 2022. But still, for the trailing 5 days, the SPY is actually up 6%. You'll realize that, or I called this out basically 2 episodes ago, looking at this. So not the month level. I was looking at this candle specifically here, this hammer at the bottom of the formation at close to the 200 EMA, where we've had support before. I was calling out basically because I really like that, even though the chart was horrible, it still is bad. That's usually hammers are, especially at the longer time horizons, year, month, week. Days are a little bit too kind of in the minutia of like intraday trading. So like, but at week levels, month levels, especially, I like looking at these patterns. If you see a hammer at the top, it's usually bad. At the bottom, it's usually a sign of possible correction or a possible significance coming or a shift in sentiment. What I liked about it when we talked about it last time was basically RSI, relative strength index. 30 and 70 are two possible areas of correction, because there's pessimism at the bottom, euphoria at the top, neither of which are really good in and of itself. So it was getting close to that area of basically over pessimism. So theoretically you could think that there's a correction. I don't take one indicator in consideration, I take multiples. So for me, I was looking at this hammer at the bottom where there's a lot of support. Also, RSI was kind of cooling off at basically at that pessimistic level, and MACD looked like it wanted to kind of pinch to start turning or possibly turning. So that's kind of what I was looking at here, and we did have a good strong week coming in this past week. I think we were up 6% basically for the trailing 5 days, which is amazing. Is it the market bottom? I'm not saying it's a market bottom, but if you remember what I was talking about 2 weeks ago, I wasn't trying to call a market bottom. That's not how I'm trying to play this market. Basically, what I'm looking at, I'm calling market value. That's how I'm thinking about it. If you look at the SPY, the forward price to earning ratio, we were about at 16.9 or 16.8 last time. I think we're closer to 17 right now. And when you look at that, you're not paying too far for your money. So that's coming down from like 21 or 22 late last year, early this year. Basically, we were paying a lot. We were overpaying for the same company. So right now you're not getting the best value. You're not underpaying, right? But you're also not overpaying anymore like we were earlier in the year. So that's kind of how I'm looking at it. Am I getting the best bang for my buck? Taking macroeconomics like out of the picture, and for me, the SPY specifically looking at this one, I am right. So I wasn't mad about that one. Also, yeah, that 378 level, as I was calling out before, like this kind of, let's say 378, right? 376, whatever, and some change. It's close to this 200 DMA, right? Which are possible areas of support. The last time we broke it, people were saying we're going to break under the 200 EMA. The last time we did that, which is this green line here, basically looking at the past 200 ticks, for each of these, like each week on this one, because we're looking at the week chart, is a tick. The last time we broke under this green line, which is all you have to know, was basically COVID, right? And if you, and thinking that we're going to break under this line, with any kind of significance, I think was like a little bit like super pessimistic. Definitely could happen, but I don't see any like major things that are kind of that are unforeseen right now. We know we're in an inflationary environment. We know interest rates are going up. We know that there's a war in Ukraine. Unfortunately, we know that gas prices are going up and summer travel season is coming. That we have, if there was something unforeseen that happened, that I think would jolt us under this 200 EMA. But we are finding a lot of support here, which I really like. I like at the week level, or RSI is bouncing up. I like at the week level, our MACD is kind of flattening out. You can't just curve your MACD bullish. You have to usually flatten out first and then kind of roll over to be bullish. And I really like this chart right here where we're sitting at the SPY, right? But we talked about that last week as a little bit more. The next one I wanted to look at, which is basically what I promised, SPYD. I don't know why I can't tap right now. Looking at the SPYD. So again, we talked about this one last week, and I promised that I will look into it a little bit more. Basically, the SPYD is the dividend, the 80 highest yielding dividend companies of the SPY, right? So look at the SPY. This is the SPYD. They're all components that what we're looking at right here of the SPY, but these are specifically the highest paying dividends, right? I like dividend plays because, especially for high interest rate environments, and inflationary environments, right? Because you're getting a quarterly dividend payment, which is basically just money to you that these companies are paying you for holding their stock or their ETF, right? Specifically. Now, this one, it doesn't have an exact date. They call it the ex dividend date. So an ex dividend date is basically saying, hey, you have to be in this ETF or this company at this date to get the payoff. They don't have a specific day that you have to be in this quarter, but looking up just historical dividend payments, it's the third week of June. So that's coming up in the next, 2-3 weeks, basically, where they're going to announce the ex dividend date to say, hey, you have to be in this, let's say June 18th. I think that's the last one I saw for last year. You have to be in here June 18th. If you hold the SPYD, you're going to get dividend payments, right? And the yield on this one's not too bad. It's 3.62 last time I checked, right? So really good there. Like I said, the top three industries for the SPYD, if you look at the SPY, right? The normal one. You're looking at tech, you're looking at healthcare, right? But this is actually the opposite, the SPYD. This is utilities, energy, and financials. They make up almost 50%, 46% of the percentage holdings of the SPYD, right? The top five holdings: Valero, Marathon, Chevron, Sempra, Williams. What do those sound like? Those sound like utility companies. Those sound like energy and oil and gas companies, right? Which is bodes well, I think, for the future of this in terms of price, because gas is going up, right? And also utilities are costing us more, right? Especially with the summer seasons coming up, the travel seasons, the time when people are going to be home more, right? Electricity goes up, gas goes up. All these things that these companies are holding is going up. I looked at this one specifically in terms of the holdings. So if I look at the top five holdings, like I said, Valero, Marathon, Chevron, Sempra, Williams, right? They're about 8% of the total holdings, right? So it's pretty diverse. There's 80 companies that this holds, so it's pretty diverse. But looking at those top five, they have a 15.15% average gap forward price earning ratio. Like, in perspective, we talked about the SPY being at 16.8, which is not overpaying, not underpaying. Well, the top five holdings of this of SPYD, the top five bad boys are 15.15 forward price earning ratio, gap forward price earning ratio, right? So you're actually kind of underpaying versus where the market is for SPYD right now, is how I look at it. The other good thing I really liked about this, if you go to Seeking Alpha, and I talk about it all the time because it's so much value to me, and it helps you just do your due diligence and checks on it, that it's a 4.88 average quant price rating. So if you look at those top five companies and you average out their quant rating, it's about 4.88. That only goes to 5. So as a holding perspective, I really like this company because you're not overpaying. You're underpaying actually compared to the SPY. You're getting a good quant rating. It's still really bullish. And actually, if you looked up, so as we said with the SPY, it's down 13% year to date. If you look at the SPYD, it's actually up 6% year to date, right? So the SPY is down 13%. The SPYD we're looking at here is up 6% over that same time. So it's overperforming the market, and you're underpaying for what you can get for that company, which I really like. And I really like this one here. I was calling this out last week because I also like it was kind of like breaking out of a rising channel. And what do I mean by that? If you go into the chart, and we're just going to look at the week level because we've already seen this one before last week, it busted over this consolidation zone, right? So basically, let's say you're looking at it basically the same time last year. So if we're looking at it last year, it finally broke over this level of $40, right? Let's say, and it was kind of finding some hesitancy, kind of rising out of this channel, right? And it's really easy to see that because it's kind of playing out this red line here. It was bouncing around, but now we finally broke out with a strong green candle over this last week into a new area, hopefully, of support where we busted out this year-long consolidation zone, right? It couldn't get over this line, couldn't get over, and then we finally busted out an in force. What I like about it, which I didn't go over the SPY there was no volume last week, which is it's not there was volume, but there wasn't volume over average. Here you see the average volume per week is about 10 million, right? And last week alone, we traded about 15 million shares, right? So there's volume over. So you have a lot of good things here. You have a catalyst coming with the dividends coming in the next 3 weeks, where you have to be in to get the dividend. You have it overperforming the market. You have it. You have a rising channel here. If you look at this, you connect these 2 points at the top. You have the top channel. You connect the bottom, 2 or 3 points. You have a lower channel. It's in a rising or ascending channel, right? And it's busted over area of usual resistance. And what I mean by resistance, it couldn't bust over this line. You see right here, it's getting rejected, getting rejected. Then we have a strong green candle with volume. You have RSI coming up, and now you have MACD looking like before we looked at SPY, it was kind of flat. Now it's pinching to go up to be bullish, right? So you have a lot of really good indicators here telling you that hey, people are buying this, right? People are in there. We have a strong green candle coming up into a new, hopefully, area of support and resistance that we can chart off of. I really like the SPYD. I called it out last week. I told her I was going to look into it deeper, and the deeper I looked, the more I liked as well, right? The next one I'm going to go into is CPG, Crescent Point Energy, and I actually called this one out originally on Twitter. We're going to just look at the month, the year. We'll start the year. I originally called this out on Twitter on June 21st. I called this one out specifically because of their tangible book value per share. It has a tangible book value per share of $9.09. Now we're about 3% away from that. So you still have that. I consider it free money. And when you think about the tangible book value per share, it's just a fancy way of saying the assets minus the debts. So every company is like a person, right? We have assets, we have debts. An asset would be a house that you buy. A debt would be a credit card payment, right? Same thing with companies, right? So when you think about tangible book value and look at this company specifically, you're saying the assets minus the debts divided by the total outstanding shares, right? The total available shares that are on the market to purchase. That's all you have to think about. I did the math for you, and basically what it is, if you look at the assets minus the debts divided by how many shares are out there in the wild, you get a dollar amount of $9.09. This was trading at fucking like $7, right? So basically that's just free money, because if a company liquidated, they would be worth their tangible book value per share. So based on just liquidity alone, this company is undervalued. That's just how I looked at it, right? Originally I called it about June 21st. I think we're like 16 or 17% up from when I called it out. So that's what I'm saying. Follow me on Twitter, or stock to us. Let's talk about it. Let's just share some ideas. But there's a lot of other things. So that got me interested in the company, right? Saying, oh shit, the price is just stupid compared to where the assets and debts are, right? That's just alone. And then I looked into it a little bit deeper, right? And I found so many things I liked. They have a dividend coming up. I mean, like I said, I like dividends. The ex-dividend date is on 6/14. So as long as you're in the company at 6/14, you get the dividend payments, right, for this one. So they have ex-dividend date coming up. They're actually the number 2 Seeking Alpha quant stock rating. They have a 4.99, and that only goes up to 5. So even stock to it sees kind of like the value of a quantitative approach to it, right? This company is actually ranked number 1 in their industry, which is oil and gas exploration and production, right? And what I really liked, I just read, I listened to the earnings and I read their presentation. They have approval to buy back up to 10% of the public float. What does that mean? So basically, until March of next year, 2023, they're authorized to buy an additional 10% of the available float. Why is that? Why that's important is because, as we talked about, that tangible book value, you divide it by the shares outstanding, that number can possibly reduce. They've been approved to reduce it by 10%. So then that brings your tangible book value, instead of $9.09, to basically $10, right? That's a whole nother dollar you get free money, basically, because your assets minus your debts divided by 10% less of that denominator is there. But also what I love about buybacks, specifically like this one, is you also increase your earnings per share by 10% artificially, because earnings per share is basically earnings divided by your shares outstanding. If you reduce that by 10%, you artificially increase your earnings by 10% also, which I really like about that one. Also, a couple other things at the macro level. And when people say like macro level, it's just like a fancy way of saying like general or abstract, right? So if you look at the grand scheme of things, the macro level, the total the economy that we're in now, we have a few catalysts that are right now and in the future. Unfortunately, we have the war in Ukraine. War is never a good thing, but what it does for gas prices and energy prices, it increases them because we're consuming them and then we're hoarding them and stuff like that. But also, we have a summer travel season coming in, so usually those are higher gas prices as more families and people are on the road, not in school, right? Also, a couple interesting ones to watch over this week, catalyst perspective. There's a meeting in Brussels where the EU is meeting. They're not expected to approve a full ban on Russian oil, but they're talking about an embargo on seaborne deliveries of natural gas and general gas and nature, like stuff like that, right? So basically, the EU is meeting to figure out how they're going to sanction Russia a little bit deeper and what they're going to do about their energy, right? OPEC also has a meeting coming up this coming up week, and they don't expect any kind of major fireworks from the OPEC meeting, but there's always like an outlier because we haven't even talked about OPEC and what they can possibly do, right? So if they say they're going to increase their production, it could negatively affect gas prices, or they can say they're going to cut production or they're going to stay as is, and that's usually bullish for gas prices if you're in a gas price company, right? And also from a chart perspective, I like this from a chart perspective as well. And we can just go into that now. And I'll just start with the week level because as we saw with SPYD upward channel, right? Same kind of difference here. You connect these two higher, right? You get the upper channel. You get two lowers, you get the lower channel. You see an area resistance. Whereas SPYD was broken out around here, this is breaking out of the channel completely, right? So basically, since when I called it, it's been in a tear, but that doesn't mean it's over yet in my perspective. Because why? You have over volume average. So to me, you have a few interesting things here, right? You have weekly bullish volume coming in, right? Where it broke and tested this area, right? So if you go into like the day level from here, maybe the 4 hour level, it not only busted over this area of resistance, it also tested it, right? So it busted out, tested back, and then flew off from there, which I really enjoy. But also not only do you have a strong green candle coming in, busting areas of resistance, you also have volume over average coming in. The average volume was 29 million shares trading for an average week. This was at 54 and some change million shares traded. Also, you have RSI busting out, and like I said, 30 and 70 are two possible areas of correction. This one can run hot though. This one has been 82, 83 before, didn't bat an eye, right? So it's all relative. These are all generalities, 30 and 70. You also have to look in perspective of the individual company itself, right? So even though this one is an area of possible correction, this has been there before and even like ran harder from it, right? But still something to think about. But what I like about this one also is MACD. So RSI to me is the faster moving indicator. It's like a quicker reaction, where MACD, moving average convergence divergence, is a little bit slower. Like you're thinking about like a sports car and like a Cadillac, right? One's gonna fucking shoot off, the other one's gonna take a little bit longer to get there. In that general, you're still gonna get both to the same directions usually, but one's gonna take a slower time. And that's why I like MACD. Even the slower moving average, like you see right here, this green candle here at the week level, it's starting to pinch to be where you want this blue line over this yellow line, and that's what's starting to happen there. So you have two indicators that are going up and to the right. You have volume over average. You have fucking price coming in, and not to say this is still 3% away from that free money. As I talked about, the tangible book value per share, $9.09. We're not there yet. You're about 3% away. That's just 3% free money to me. You also have that dividend date coming in. Now you also have the energy prices that are coming in. You also have summer travel. You have, there's just to me, there's a lot to like about this, which I really enjoy, right? And that's why I called it out, about 2 weeks ago now. And that's why, I'm kind of like still kind of talking about it to this day. The other one I wanted to talk about was GME for all my apes. I've been there. I've been in GME before. I love it. It's a fun time. It's a high risk, decent reward. And what I like about GME, the reason I'm calling out now, I'm going to take some of this Jameson on the rocks. Man, that's damn good. Okay, the reason I'm talking about GME specifically here is they have our earnings on June 1st after market close. So looking at my calendar, that's Tuesday, so Wednesday after market close. The reason I'm watching GME though, not just for the flex of it because it's fun, but also because the underlying options for this are implying a 20% movement from earnings. Holy shit. 20% movement? That's crazy. When I do look, so when I break down the earnings, you know me, when I play earnings, I like to put the numbers, I like to look at them that way. I will say the same quarter year over year estimated EPS is down 75%. So looking at this time last year, this EPS is 75% lower than what it was this time last year, right? Not a good thing, right? Looking at the last 20 quarters of EPS, they beat EPS only 55% of the time. And they beat revenue over those last 20 quarters 50% of the time. Those aren't good numbers to me, right? But what's interesting to me here is actually it has a 24% short interest. And when you think about those short squeezes and stuff, those are happening because the float level that is considered short is 24%, right? So anything above, 20%, 15%, it's really easy to have a short squeeze where these short positions who are betting it to go lower, the price goes over what they're at and they have to cover at the higher price, creating buyers out of the sellers, right? Because you have to rebuy those shares to sell them back. Anyways, it's all nerdy shit, but basically there's a 24% short interest. Anything above 20 is really interesting because if this can pop the right way, I would look at this more of an intraday play for myself on the earnings. If I have time Wednesday, that's how I'm going to think about playing it as an intraday because at the end of those earnings, if someone likes if the I will start buying it because of the short interest or because they lost less money than they thought or their revenue was increased because for GameStop we're really not expecting them to like win on efficiency and earnings, right? You expect if their revenue number is really good or they give you some really good guidance. That's the thing we don't see here is guidance. The company comes out with bad earnings. Let's say they miss earnings, they miss revenue, but they have great guidance. That can be enough for people to start buying it, and then that causes those shorters to start covering. That 20% price move that's what makes it interesting to me. And as a basically intraday or end of day trade, I would like this one. But also, like I said, high risk, decent reward. But what's interesting with this one and why I was looking at it a little bit closer is because even though we talked about GME being like we talked about GME kind of like oh, sorry, we talked about SPY being down 13% basically for the year. GME is holding up really good year to date. And it's interesting because it has like kind of like a double, triple bottom here at this 200 EMA, which at the week level, which I really like. So if I could buy this closer to this 105 level, right now, 103, 107, it's a little, or sorry, it's 148, maybe let's say, 137, a little bit extended. But if I could have caught this at like, that $100 area, because there's a lot of support here, there is a lot of support. So it's not a bad risk to reward ratio if you're saying, okay, I'm going to get it closer to this weekly EMA, 200 EMA, and I'm going to play it, for the upward side swing. That's not a bad way, I think, to think about it, as long as you have your risk reward ratio, right? Like this 102 level, right? But we have indicators going up at the day level. Over the past 3 days, we've had volume over average coming in, which is interesting to me. I really like this one as a setup into earnings as a momentum play. Specifically, maybe it wouldn't be intraday because it'd be end of day, but I kind of like this one, especially if you can get a short squeeze out of it. The last one I'm going to go into, and I promise I'm going to shut up, is Amazon. And the reason I'm calling out Amazon, I'll just leave the chart up here so you can kind of, look at it yourself a little bit. The reason I like Amazon, because on June 6th, we have a 20-for-1 stock split. So basically, for every one share that you have of Amazon, at June 6th, you're going to get 20 shares. You still have a week, a few days to get into Amazon to get that 20-for-1 stock split. And why that's important. So the stock split is not going to impact valuation or market cap, any of the fundamentals of the financials for the company, right? But so basically, right now, Amazon has a forward price to earning ratio of 145. That's fucking expensive. And in perspective, CPG is at, CPG is at, did I even say what CPG was at? It's actually pretty low. I'll get that number. But anyways, as we talked about SPYD, the top 5 companies are 15% forward price earning ratios. If you're looking at the SPY, it's actually at 16.9, let's say 17. And that's basically fair value if you look at historical prices. Well, Amazon is at 145, which is fucking amazing, right? Like it's pretty expensive. In terms of how much you're paying. So when you do a 20-for-1 stock split, you're not actually affecting any of those any of those fundamentals from a company perspective. Oh, sorry, the forward price earning ratio for CPG, so the company we looked at two before, the oil and gas company, it's like three and some change, right? So that's perspective. It's not expensive. Amazon is very expensive. But what you get for that is a company that's basically everywhere. They're AWS, Amazon Web Service. So they're the back end data infrastructure of so many companies. They're Amazon. They have a shipping and logistics part. You order things from Amazon every day, right? So that's why you're kind of paying up for that Amazon price. It is expensive, but also it's everywhere in your life. So maybe you could make the argument that it's worth it. But the reason I like split companies and the reason why I think Amazon is a little bit different is we've had three major splits, like for public, huge publicly traded companies for the past couple of years. We've had Apple, we've had Tesla. Those are both, so Apple and Tesla were the same day in August 28th, 2020. And we had Nvidia, which is basically July 2021. Those were all like 4-for-1, 5-for-1 stock splits. And if you like I said, look at Apple, look at Tesla, where they were trading August 28th of 2020, where they are now. They're up, right? So post split, these companies are going up. Nvidia, they split on like I think late July 2021. Look up where they were July 2021 and where they are now. They're up. I think they're kind of like, it's kind of coming full circle. But my point is that they raise after splits. And this one for Amazon specifically is different, in my opinion, because it's a 20-for-1 stock split, where these other ones were 4-for-1, 5-for-1 stock splits. The next one coming up is Google. And I love me some fucking Google. So I'm really watching Amazon for that kind of pop. Not, they're expensive. That's not what I'm worried about. When I'm worried about a split arbitrage play, I'm worried about the stock price going up based on the split alone. And we've seen, like I said, with Apple, Tesla, and Nvidia that they have risen after earnings, right? Also, what I like about this one, and when I was looking a bit into it, is this 2020, let's say this 2022, 2027 area has been very significant for a company basically since 2018, right? So if you look at this chart, and you look at here where we are, let's say August 2018, right? Look at that. Boom. We had triple top here at the week level, right where we are now, right? This has been an area of significance for Amazon basically for the past 3 years almost, right? That it's been significant. And look at what it's doing. It's holding up really well, right? Almost like a hammer forming at the month level here at this 2038, let's say. What I like about that is kind of finding that resting place before the stock split, which I really enjoy about it right now. You do have at the month level we still have one day of the month left, but you do have average volume over average. You haven't seen volume over average basically since 2020, late 2020, right? We're seeing that here. It is the downside. You see RSI going down, you see MACD going down. Not the best look, but it is holding support where it has found significance at previously, and it shows it a little bit better at the week level, which I like the week level better. So like you see 3 weeks of it tipping this line at, like, let's say you get a little bit deeper here. So 2023, fuck it, whatever. It's 2027, 2023, whatever you think about it, right? It's tipping the line here. It's touching it 3 weeks in a row. You have volume over average coming, but it hasn't been able to break the support right here. You do have, like I said, RSI, it dipped to the 30 level. Now it's trying to round back up to go bullet or to go to the upside, right? It needed to correct here. It did at that 30 level. You have, and importantly, MACD is kind of rounding out as well, right? So you see RSI curving, you see MACD curving. It's not bullish yet, but it's rounding out to be less bearish, right? And you see 3 weeks of it finding support in an area where it's found support previously, right? So I really like Amazon from a chart perspective for sure, because it's finding support, like I said, where it needs to. You have a few different indicators here like telling you, hey, this is an interesting level, right? You have MACD, which isn't going down, it's flattening out. You have RSI picking up. You have price action finding support at this level, touching this level, right? And then rising up off of it, right? Which I really enjoy. And you have volume confirming that this is an interesting area here. Also, you have the stock split coming up 20-for-1, which we've never seen before, basically. Like I said, go look up Apple, Tesla, and Nvidia on the days and then post days after their split and see what these companies do. I'm looking at this not only from I probably won't play Amazon because I'm pretty heavy in Google, but I want to see what Amazon's going to do from a watching perspective. Maybe play it. Fuck it. That'd be fun. But I want to see what it's going to do to kind of uh, go into like maybe how Google's going to be played. Because when we think about July 2021, that was so long ago. Not let alone when Tesla and Apple split, which is basically in the middle of 2020. That was a whole different macroeconomic environment, right? So it's not to say it's going to rise because those did, but those are good indicators of things that historically to watch because those are kind of very similar. Anyways, I'm gonna wrap it up. We had SPYD bringing those bad boys back. I called them out a couple weeks ago, and I'm gonna keep calling them out and watching them because they're interesting to me. I like those plays. CPG, we're 3% away from that intangible book value, but let's say this company buys up that 10% of the available float. You're gonna raise that 9.9 to $10. That's $10 of free money right there. But keep in consideration, CPG trading at $9 or under $10. Anything, in my opinion, anything under $10 is a penny stock. So this is definitely high risk, high reward because it is a more volatile company as a penny stock, in my opinion. But I really love it. GME also for that 20% options movement possible, that 24% short interest float. Fuck, let's go. And Amazon for that 20 for 1 stock split that's happening June 6th. Get in there if you want that 20 for 1 stock split. But yeah, everyone have a great day. Good luck this short week and get some rest. Peace.